The world of digital assets, especially stablecoins, it can feel like a really complex puzzle sometimes, can't it? One minute it's all about groundbreaking innovation. The next while you see headlines about volatility or, frankly, just a lack of clear rules. It moves so fast, really hard to keep up. But what if you could cut through some of that noise, really understand the efforts being made to bring clarity and stability to this pretty crucial part of the digital economy? Well, that's exactly what we're aiming to do today in this deep dive. Our focus is a potentially really significant piece of proposed legislation. It's aimed at creating a clear regulatory framework for payment stablecoins right here in the United States. The formal name is the Guiding and Establishing National Innovation for U.S. Stablecoins of 2025. Catchy, right? Or maybe just the Genius Act of 2025. This was introduced in the Senate back on February 4th, 2025. So our mission today, really for you, is to pull out the essential nuggets of knowledge from this proposed bill, help you understand how it defines stablecoins, how it aims to regulate them, and maybe secure their future. We're hoping to turn that complex puzzle into a much clearer picture. Let's dive in. Okay, so let's unpack this. The first big question really is, what exactly does this bill mean by a payment stablecoin? How does it draw that line?
Yeah, that's definitely the right place to start. The Genius Act, right up front, gives us a very specific definition. So a payment stablecoin, it's a digital asset, primarily designed or used as a means of payment or settlement. That's its job. And here's a really critical part. Its issuer, the company behind it, has a firm obligation, like a promise, to convert, redeem, or repurchase it for a fixed amount of money. Think of it like a digital token that's always meant to be worth, say, exactly $1. The issuer has to represent that, or at least create a reasonable expectation that it will maintain that stable value. And just as important is what it isn't. The bill is very clear. It's not a national currency like the US dollar itself. And it's also not a security like a stock or bond issued by an investment company. That distinction is really vital because it immediately sets it apart. It's not an investment. Fundamentally, it's meant to be money, like a medium of exchange.
Okay, that makes sense. So if that's the definition, who then under this proposed law would actually be allowed to issue these things? Is it just traditional banks, or is there room for, new kinds of companies?
Right, that leads us to the concept of a permitted payment stablecoin issuer. The bill lays out three distinct categories. First, you've got a subsidiary of an insured depository institution. So basically a part of a traditional bank or credit union that's already federally insured, like by the FDIC, familiar territory. Second, there's something called a federal qualified non-bank payment stablecoin issuer. These could be newer, maybe tech-focused companies that aren't banks, but they'd get a special federal license and come under direct federal oversight. And third, you have a state-qualified payment stablecoin issuer. That's an entity approved and regulated at the state level by a state regulator specifically for stablecoins. So yeah, it's a mix, but a very controlled, very specific mix.
That is interesting. So not just banks, but it sounds like the bill is incredibly strict right from the get-go about who gets to play in the space. I mean, the very first rule, Section 3, basically says it's flat out unlawful for anyone other than one of those permitted issuers to issue a payment stablecoin in the U.S. That seems like a really strong opening statement. Why start with such tight gates? Doesn't that risk stifling innovation?
It is a powerful statement, definitely. And the implication is pretty profound. This strict limitation right away funnels all legitimate payment stablecoin activity through these very specific regulated channels. It's a deliberate move, to try and prevent unregulated entities from popping up and potentially causing issues, especially given some of the volatility and, frankly, failures we've seen in the wider crypto market. It's really about building a foundation of trust and accountability from day one. Instead of, trying to clean up a mess later, the idea seems to be fostering responsible innovation within clear guardrails.
Okay, so once an entity gets the green light, becomes a permitted issuer, the Genius Act then lays out some really specific, pretty robust requirements. Let's start with the big one, the thing everyone always asks about with stablecoins. How they have to be backed, what are the rules there?
Yeah, this is absolutely core to the bill, ensuring that stable value isn't just a promise, but backed by real assets. It mandates really stringent one-to-one reserve backing standards. And it's not just any assets. The list is very specific, focused on safety and liquidity. We're talking things like actual United States coins and currency, Federal Reserve notes. Also, funds held as demand deposits, basically. Cash in checking accounts at insured banks or credit unions. And critically, U.S. Treasury bills, notes, or bonds, but only those with very short maturities, generally 93 days or less. Super safe stuff. It also allows for certain very specific ultra-short-term repurchase agreements, often called repos, and certain money market funds. But here's the catch. Those money market funds have to only invest in the other permitted safe assets, like those short-term T-bills. The whole point is crystal clear. For every digital dollar issued, there must be a real, safe, immediately available dollar or dollar equivalent sitting in reserve. One-to-one. All the time.
And it's not just what they hold, right? But how they hold it. I saw the bill specifically mentions rehypothecation. That sounds technical, but you mentioned it's critical for preventing risky stuff. Can you break that down a bit? Why is that detail so vital?
Absolutely. It's technical, but super important. So rehypothecation. Basically, the bill says these reserves, the assets backing the stablecoin, cannot generally be pledged, reused, or, well, rehypothecated. Imagine you put $100 in a special safety deposit box. Rehypothecation would be like the bank then taking your $100 out of that box and using it as collateral for its own borrowing, maybe without you even knowing. That kind of practice, reusing collateral that's supposed to be backing something else, has actually contributed to financial instability in the past. It creates hidden leverage, systemic risk. If everyone relies on the same underlying asset that's been promised multiple times over and there's a panic, things could unravel fast. So this bill's ban on rehypothecation, with only a very narrow exception for using T-bills and repos just to manage short-term redemption needs, is really fundamental. It speaks directly to consumer confidence. It ensures the assets backing your stablecoin are actually there, dedicated only to your stablecoin, not being used for other risky ventures. It avoids those past mistakes.
Got it. Okay, that makes sense. Transparency also seems like a huge theme here. The Act requires public disclosures, even audits and certifications.
Huge theme, yes. Transparency is woven throughout. Issuers have to publicly disclose their redemption policy, how you get your dollar back, and have clear procedures for making that happen quickly. Beyond that, they absolutely must publish the monthly composition of their reserves. Right on their website, they have to show the total amount of stablecoins they've issued and then the exact amount and type of reserve assets backing them up. And this isn't just self-reporting. That monthly reserve report has to be examined, essentially audited, by a registered public accounting firm, an outside check. And here's the kicker for accountability. The CEO and the CFO of the issuing company have to personally certify the accuracy of these monthly reports to their main regulator. There are even potential criminal penalties attached under federal law if they certify something false. So this isn't just a paperwork exercise. It puts real executive accountability on the line.
Wow, okay. So beyond the financial backing and transparency, the bill also gets into operational stuff, risk management standards. It's not just about the money, but how the whole thing is run day to day.
Exactly. It's a holistic approach. The regulators, whether federal or state, will jointly issue requirements covering a whole range of operational risks. This includes things like capital requirements, making sure the issuer itself has enough financial cushion for its ongoing operations, separate from the customer reserves. It includes robust liquidity and interest rate risk management. They need to be able to handle fluctuations and always meet redemption requests, even if interest rates change. And then there are comprehensive standards for operational risk, compliance risk, IT risk management. Things able to handle fluctuations and always meet redemption requests, even if interest rates change. And then there are comprehensive standards for operational risk, compliance risk, IT risk management. Think cybersecurity, preventing hacks, ensuring systems are reliable. And a key piece here, all permitted payment stablecoin issuers are explicitly treated as financial institutions under the Bank Secrecy Act. That means they're subject to the same strict anti-money laundering, know your customer, and counterterrorism financing rules as traditional banks. A big compliance lift, but seen as essential. These standards can also be tailored a bit depending on the issuer's specific business model and risk profile.
Okay, and finally, on the requirement side, it's interesting that the bill seems to really limit what these permitted issuers can actually do as a business. It sounds like a very narrow focus.
It is a very narrow focus, and that's quite deliberate. It's about creating a kind of ring fencing or firewall for risk management. Basically, a permitted payment stablecoin issuer can only do a few things: issue and redeem their payment stablecoins, manage the reserves backing them, maybe provide custodial or safekeeping services for the stablecoins or the private keys, and undertake other functions that directly support these core activities. They generally can't engage in other types of business, like lending or trading unrelated assets. This specialization isn't random. It seems like a direct lesson learned from past financial crises, where problems in one risky part of a large, complex firm could bring down the whole thing, even the safer parts. Here, the idea is that payment stablecoin issuers must focus purely on that core function, issuing stablecoins and maintaining their value reliably, keeping the stablecoin system itself clean and insulated from other risks. Oh, and just a small note, for those federal non-bank issuers we talked about, the bill specifically names the Office of the Controller of the Currency, the OCC, which normally supervises national banks, as their primary federal regulator.
Right, got it. So bringing this all together, the Genius Act doesn't just set up one federal system. You mentioned it also carves out a pretty significant role for states. How does that dual path actually work in practice?
Yeah, this dual regulatory path is one of the really interesting, maybe complex parts of the bill. It basically says that stablecoin issuers whose total market capitalization, the total value of all their stablecoins out there is not more than $10 billion, they have an option. They can choose to be regulated under a state-level regulatory regime if one exists in their state and meets certain criteria. The crucial condition, the big if, is that the state's regulatory regime must be deemed substantially similar to the federal framework laid out in the Genius Act. It has to offer comparable protections and standards, so it allows states some room to innovate and tailor regulation, maybe be a bit more nimble, but only if they maintain a high bar that's basically equivalent to the federal rules.
So states can kind of do their own thing, but only if it's good enough by federal standards. How is that good enough part determined?
There's a formal certification process. For a state regime to be recognized, the state's banking supervisor or equivalent regulator has to certify to the U.S. Secretary of the Treasury that its rules meet those substantially similar criteria. They have to do this initially within 1 year of the act becoming law, and then they have to redecertify every single year after that. Now, if a state regulator fails to send in that certification, or if the Treasury Secretary looks at it and says, nope, the state's rules are not substantially similar, then things change. In that case, any payment stablecoin issuers operating in that state automatically fall under the federal regulatory framework, regardless of their size, even if they're under $10 billion. There's a process for issuers to challenge that determination in federal court, specifically the U.S. District Court for D.C., and the Treasury Secretary is tasked with keeping and publishing a public list of which states are certified.
Okay, but what happens if a state-regulated issuer starts small, under $10 billion, but then it grows? It gets really popular, crosses that $10 billion threshold. Do they just stay under state rules, or is there some kind of mandatory switch?
No, they don't just stay put. There's a very clear transition mechanism built right into the bill for that scenario. If a state-regulated depository institution like a state-chartered bank subsidiary is issuing stablecoins and its market cap rose to more than $10 billion, it must transition to being regulated by the Federal Reserve Board. They get 360 days to make that switch. Similarly, if one of those other state-qualified non-bank stablecoin issuers crosses that $10 billion market cap threshold, they have to transition to being regulated by the Federal Controller, the OCC, also within 360 days. The only other option they have is to stop issuing new stablecoins until their market cap drops back below the $10 billion mark. So it's a clear path. As you get bigger and potentially more systemically important, you come under the umbrella of the main federal regulators, the Fed or the OCC. The bill does say they are conditionally approved while applying, and the federal regulator could potentially waive the transition requirement in certain specific circumstances. And what's really fascinating here,
Even when an issuer is operating under a certified state regime below that $10 billion cap, the bill still gives the big federal regulators, the Fed and the controller, a kind of emergency override authority. They call it intervention in exigent circumstances. If these federal regulators see a situation with a state-qualified issuer that poses a serious risk to financial safety, soundness, or the stability of the wider financial system, they can step in. They have to give a state regulator at least 5 days written notice first, but then they can take direct enforcement action against that state-level issuer. They can impose immediate restrictions, things like limiting dividend payments, blocking certain transactions between the issuer and its parent company, or stopping activities that could create liabilities for the holding company. The rules defining exactly what counts as exigent circumstances have to be issued pretty quickly, within 180 days of the act passing. But this basically ensures there's a federal safety net or backstop for the whole system, even for the state-regulated players, if things really start to go wrong. There are review and appeal processes for these actions too, of course.
Okay, shifting gears a bit. Beyond just how stablecoins are issued and regulated, the Genius Act seems to put a really high priority on protecting you, the customer, the person actually holding or using these stablecoins. That seems crucial for building trust, right?
Absolutely crucial. You can have the best issuance rules in the world, but if people don't feel their funds are safe once they hold the stablecoin, it won't work. The bill has quite detailed customer protection provisions in Section 8. For instance, it restricts who can even provide custodial or safekeeping services for payment stablecoins or their private keys. It has to be specific regulated entities. Think entities already supervised by federal regulators like the Fed, OCC, FDIC, SEC, or CFTC, or state bank or credit union supervisors who importantly agree to share information with the Federal Reserve Board. Not just anyone can hold your digital assets. And a real cornerstone of this is the segregation requirement. Custodians, the ones holding the assets, must treat customer assets, the stablecoins themselves. The private keys needed to access them, any related cash as belonging to the customer, not to the custodian. And they have to take concrete steps to protect those customer assets from the custodian's own creditors. So if the custodian goes bankrupt, your assets shouldn't be swept up to pay their debts. Tied to this is a general commingling prohibition.
Customer assets have to be separately accounted for and generally not mixed together with the custodian's own operational funds. There are some narrow exceptions, like for convenience using omnibus accounts at insured banks, where multiple customers' assets are held together but still segregated from the bank's funds, or for temporary mixing during transaction settlement. But the principle is clear. Your assets are yours, kept separate and safe.
Okay, that segregation piece sounds really important, but it raises the inevitable question. What happens if the stablecoin issuer itself fails, if they become insolvent? That's been a huge fear in the crypto world, often with a lot of uncertainty about who gets what back.
That's a critical point, yes, and the bill addresses it directly and quite powerfully in Section 9. It states very clearly that in any insolvency proceeding that includes bankruptcy under Title 11 of the U.S. Code, the claim of a person holding the payment stablecoins issued by that failed issuer will have priority over all other claims against the issuer. What that means, practically speaking, is stablecoin holders get paid back first, before other general creditors, before equity holders, before almost everyone else. Your claim as a stablecoin holder goes to the front of the line. Furthermore, the bill clarifies that a payment stablecoin issuer that isn't a traditional bank can still be considered a debtor under the U.S. Bankruptcy Code. They are explicitly subject to the established bankruptcy process. So if you connect this to the bigger picture, this is a massive consumer protection. It establishes a clear, predictable hierarchy if an issuer fails. It's a major departure from the often very murky and uncertain situation we've seen with other digital asset failures, where figuring out who owned what and who got paid back was, frankly, a nightmare. This aims to bring much-needed certainty and security for holders.
Wow, okay, that priority in bankruptcy, that's huge. So beyond these direct customer protections, the Act also seems to tackle some other big-picture legal questions, and even looks internationally.
It does. On the legal status front, it addresses a really long-standing debate and source of uncertainty in the crypto space. Section 14 of the bill explicitly amends several major U.S. securities laws. We're talking the Investment Advisors Act, the Investment Company Act, the Securities Act of 1933, the Securities Exchange Act of 1934, even the Securities Investor Protection Act. It amends all of them to clearly state that a payment stablecoin issued by a permitted payment stablecoin issuer, as defined in this bill, is not a security for the purposes of those laws. That provides immense regulatory clarity. It basically says, look, these specific regulated payment stablecoins are payment instruments, not investments, drawing a clear line, at least for these permitted types. And yes, the bill definitely looks beyond U.S. borders, too. Section 10 mandates that the federal regulators assess and potentially set standards to promote compatibility and interoperability among different stablecoins. The idea is to make sure they can work together seamlessly, which helps payments.
And Section 15 directs the Federal Reserve and the Treasury Department to work on creating reciprocal arrangements or bilateral agreements with regulators in other countries. Specifically, countries that have their own stablecoin regulatory regimes that are considered substantially similar to the U.S. one proposed here. This is all about setting the stage for smoother global cooperation and making international digital transactions easier and safer.
Okay, one last piece that caught my eye. There's a fascinating mandate in the bill, Section 11, for a study specifically on a different type of stablecoin, endogenously collateralized stablecoins. What on earth are those, and why single them out for a study?
Right, this is a really interesting forward-looking provision. It shows that the lawmakers recognize the stablecoin world isn't monolithic, that there are other models out there besides the fiat-backed ones this bill primarily regulates. So an endogenously collateralized stablecoin, according to the bill's definition, is basically a digital asset, where the originator, the creator, says it will maintain a fixed value, like a dollar. But, and here's the key difference, it relies solely on the value of another digital asset created or maintained by the very same originator to keep that fixed price. Think of them algorithmic stablecoins, perhaps, where the value is maintained through complex interactions with another crypto token issued by the same project, often without direct backing from traditional assets like dollars or bonds held in reserve. The collateral is endogenous. It comes from within the same system. The Treasury Secretary, working with the Fed, OCC, FDIC, and importantly the SEC too, is required to conduct a study on these types of stablecoins within a year of the act passing.
They'll look at how they're designed, who uses them, what reserves, if any, they claim to have, the algorithms, the governance, how they're advertised, disclosures to consumers, the whole picture. This really suggests a recognition that while this bill focuses on getting rules in place for the most common type of stablecoin right now, there's a need to understand these other potentially riskier models much better to inform future policy decisions. It's about being prepared for what else is out there or what might come next.
Okay, so wrapping up our deep dive into the Genius Act of 2025, what we've seen is a proposal for a really comprehensive, kind of multi-layered regulatory framework specifically for payment stablecoins in the U.S. It hits hard on stringent one-to-one reserve requirements with very safe assets. It emphasizes robust transparency, public disclosures, third-party audits, even CEO, CFO sign-offs. It sets up clear lines of authority for supervisors, using that interesting dual path for federal and state regulators, but with federal oversight kicking in for larger players or in emergencies. And crucially, it seems to put significant focus on customer protections, like asset segregation, and that really important priority for stablecoin holders if an issuer fails. Plus, it clarifies that these permitted stablecoins aren't securities, and it even looks ahead to international cooperation and the need to study other types of stablecoins. It covers a lot of ground.
It really does. Stepping back for a moment, if this bill were to become law in something close to this form, it would represent a truly significant effort to bring, well, much-needed clarity and stability to this rapidly evolving corner of the financial world. The clear aim seems to be fostering responsible innovation, allowing stablecoins to develop as payment tools, but doing so within strong guardrails designed to mitigate the kinds of risks that have, frankly, plagued the broader crypto industry in recent years. It's about moving stablecoins from a sometimes volatile, uncertain space towards being a more integrated and trusted part of the financial system.
So maybe a final thought for you, the listener, to mull over. As you think about all this, consider, how might this proposed framework for payment stablecoins, with its heavy emphasis on regulated issuance, strict reserves, and strong customer protections, how might that influence the rest of the digital asset ecosystem? Could it potentially accelerate the mainstream adoption of these specific digital currencies here in the United States?